Everyone's doing well. Haven't made a video in a while, so I want to get back into the habit of doing that. As always, please comment just on general questions or email me or send me a message on price action. Really, it's easiest just to comment on the YouTube channel because I'll probably see it quicker. So anyways, let's get started. So I've been trading mostly Forex and just to kind of give you a recap of the past really couple months, I've been trading really just Forex. I like it. I like multiple time frames, and I'm growing to enjoy holding trades on higher time frames, and obviously going for larger amount of pips as opposed to a 5 to 15 minute chart. So, anyways, let's just I'll talk about the Emini. I have not traded the Emini in a while, but I like to I'll watch it during the day and kind of just keep up with it. So let me. In terms of the Emini, here's the session breaks. As you can see, we've had a pretty strong rally, and that's in part due to sideways bear breakout, sideways for a few days, strong bear breakout. Well, think about it. We just broke below major support. So on this day, the 27th, which that was, let's see here, the 27th was it's a Monday. Strong breakout. I got to turn off these session breaks. I really just don't like session breaks. They kind of bother me, to be honest. Anyways, bear breakout. It's a gap down, bear breakout. And then we had a strong rally. So you're always in long, stop down here. Probably going to test down here. Very tight channel. And you can see we had a wedge top, 3 pushes up. Bull's got a bull break out of the wedge top, went for a measuring move up. Anyways, probably a measuring gap, so you have to be open to something like this. It's probably, obviously we did that. So clearly always in long, finally got a 2-legged trend line break. And again, it's a major trend reversal, probably left to retest the high and form some sort of trading range. The bears never went always in the short. We opened here, we tried to break the low down. So really, I don't want to go in too deep. A lot of this concept is from Al Brooks. Actually, that's not what I meant to say. All of it's from Al Brooks. His new video course is, really incredible. So if you really want to learn, watch his video course. Sideways, trading range, and then the bulls got their upside breakout, probably at least a second leg up. The bears tried to reverse down, but tight enough channel that would make it more up, and you can see the bears failed again. And we just kept going up. So becoming parabolic, we got above these highs, and pretty decent trend line break, but still probably left to retest the high. And you can see easily going sideways for quite a few bars. And yeah, and then we've been really channeling going sideways for quite some time. Monthly chart. So well, that rally obviously made the bear body pretty disappointing. I still think we'll get down to here at some point, and I do certainly believe that we will get to the December close because it's right here. And if I think we're going to get down here, I think we'll easily test back down here. The rally we had on the monthly chart, it was already climactic. So, I think there's a very good chance that this year will be a bearish year just because you've got to think the daily chart, here's the close of December. And you have to think. Think about the math for a minute. So it's April. So I get it. It's not quite, we're close to 6 months. We're close to the first half of the year being over. So think about if you sell stop up here, betting that we at least get down to here. I think it's better for the Bears. Obviously, if the Bears use a wide stop, not bad, but we're at a measure move target of this trading range. They use a wide stop of something like this or this. The chances are better, but I think we're going to get back into this range. So I'll talk a little bit about, first off, I'll talk about crude oil. Crude oil's, fairly good rally on the daily chart. As you can see, big down, big up, sideways. So upside breakout, failed to break above, went sideways for, many, many months. Downside breakout, look what happened. We went below here, kind of parabolic wedge, and found buyers. So you're at support. Price failed here, 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 here. It's failing again here, failed here. Probably going to break to the upside. And we'll probably test this low. So think about it. If you're a bull, no surprise there. You buy this low, and you see this, you see it race down, and you go, darn, I'm trapped. Well, a lot of bulls will exit on this bar, and that's why we did this. Other bulls will just say, I'll just buy a measured move down. So, I'll buy at a minimum, I'll buy somewhere right here, which is this low. From this high to this low, I'll buy in this area. And others will just say, I'll just buy above a bull bar. Strong breakout, first left should fail, retest the low, we fell below this low, so we're at support, and so we're at a place to buy. So they'll buy, and some will exit a break even, which would be, really, let me illustrate one short thing, but I think this is a reasonable trade, which kind of explains right here, is let's just say you buy somewhere in here. So you buy one of these lows, and then you buy more. Let's just say you buy at this low. And really, I'm actually wrong. You would not have been filled right here. So, anyways, you buy here, you buy lower. You obviously can get out of break even. I think we'll get a higher low and a second leg up. So, maybe something like, maybe we get so in other words, we get a pullback, 50% pullback, maybe a little lower that takes you back to here. Anyways, I think we'll get up to here. Monthly chart, finally got a trend line break. We're going sideways. If anything, I would be long, maybe, maybe you're long, stop down here, willing to scale in, betting the price gets up to here. Really, it's not really a great trade, but I think I'd rather be long than short, even though we're clearly always in short. Had I been short, I think a lot of bulls would get out here, and I wouldn't get short again here. So, I think the Bears are at least waiting for many months, and it's probably turning trading range, so sideways, bear breakout, more sideways, thin area, so we'll probably fill the gap. All right, so 240-minute chart of the euro dollar. As you can see, sideways for many months. Broke to the upside. You can call it a double top. You can call it three pushes up, a wedge. We broke to the upside, failed. Strong enough breakout. It's nested wedge. You know, 1, 2, 3, 1, 2, 3. Probably get a second leg down in the minimum. If the bears are lucky, you'll get some sort of measurement down. I think we'll at least test this low. You know, USDN, we've had this strong rally, easily sideways from many bars. So, you know, enough for a swing down. So it's probably more of a trading range. Bears had a chance at a bear breakout. Looks like they're failing. You know, I like the yen the most, USDN. Favorite Forex markets are the USDN and the Euro dollar and the Great British Pound. However, I really like to trade the Euro dollar on 60-minute and above charts. I say that I like them all. I really do trade quite a few 60-minute trades. You know, for example, I really can't remember. Well, anyways, I don't want to get too in. Oh, now I remember. You know, things like price test down, buying this close, betting that price gets back to the middle, buying down here. Things like that. I like the Emini for a little bit. I'll talk about always then. I just don't have a lot to say about Forex. So here I'm gonna go to a random day. So right here, let's just talk about always then. So trading range, I'm gonna assume this is all I see. So bar one always in long. Bar one always in long, but trying to break above this range probably will fail. Bulls, maybe they get out below bar three here. If they don't, I'd probably get out below here. Certainly below that bar. Are we always in short? I don't know. 50-50 chance we'll probably fall below this low. I suspect we will. Just because 20% of the time, 1 out of 5 days, the first bar is the low of the day. Sideways mini bars, probably pretty neutral. Finally got to the moving average. We have a gap here. And there you go. So looks like this was we had a report on this bar. Trading range day. Well, two things. So the open of the day is 63.75. Yeah. Probably will get some sort of measure move down, maybe of these bodies to there, and then possibly from here to here. So trading range day, bears buying down, bulls buying down here probably will make money, and there you go. Again, bulls buying probably will make money. I think at this point we'll probably test the open of the day again. So always in short, yes, but trading range, micro double bottom. You can call it a low too short. You're going to have bulls buying. It's going in lower and using wide stops. And you can see, well, anyways, so always in short, where do bulls get out? They got to get out probably here, but then they got to get short again. It's a wedge top, so probably bear flag, and still probably always in short. Again, I think bulls, bears get out, bulls maybe get in, but if they buy here. I think they're betting on a test up to here. But the problem is bulls keep trying and they keep failing. So maybe bull, always in bulls buy, but they probably get out below there. If the bears sell, I don't know. I wouldn't sell down here. So again, if the bear did sell, they get out. Bulls probably go long, betting for test to be open. You can see we came within 5 to 63. Came within one tick of the open of the day, so it might be enough of a test. I still think we'll get to the open of the day, because that's usually what happens. There you go. Price went one tick above the open of the day. Mission accomplished. So the reason why I was saying that at the beginning was typically there's symmetry on a trading range day. And what I mean by that is when you have a trading range day, what is a trading range? A trading range is perceived, there's value. So something over here is valuable. When it goes up, what happens is price is probing up and down. So look at my mouse, it's going down, up, down, up, down, up, down, up. So when price goes up, eventually there's no buyers, only sellers. Price has to vacuum back down to where bulls will buy. Well, price opened at the open of the day. It tried to go X points up. And a lot of traders, on most days, will bet when they think it's going to be a trading range. They'll start selling, 4 points above the open or 4 points below the open. So, for example, say price opens and you think, probably a trading range day. I'm going to let it sell 4 points above, especially after this bar. So, especially when they see that in the trading range. So a lot of bears will sell 4 points above. So the open of the day was 63.75. They'll look to sell it 67.75, somewhere up here. And maybe they use a stop 4 points above, or maybe they scale in 4 points above. Anyways, price will probably retest, and that's what happened today. Again, same thing down here. So the open of the day is 63.75. Bulls will buy. If I said bulls, I meant bears will sell 4 points above. Bulls will buy 4 points below. So 63.75. A lot of bulls will buy at 59.75. So 59.75. Look right here. Look what happened. The low of the day was 59.75. So many bulls tried to buy there. You actually had quite a few bulls front running and buying a few ticks above. So maybe they buy 3.5 points below, and then they quickly scalp out. So you can see right here, price went down, did it again. So same thing could have happened down here. Technically a bull could have bought here and more lower, but I think if a bull was buying 4 points below, looking to retest the open, I think when they did, they'd scalp out. That's more of a scalp trade. The same thing applies to, you could do the same thing here. I think one, exhaustion. So what a lot of traders do, and I'll make a different argument. I'm kind of jumping over the play. I'm trying to, sorry, get kind of, mixed up in my own thoughts. Take exhaustion gaps. A lot of bulls will buy here, buy lower, or maybe they buy this low, stop, a measured move down, and so they'll buy this close, stop somewhere down here. Maybe they buy lower, and then they scalp out up here or up here. If you think about it. And this is really what I'm going to be talking about right now is more of just kind of my thoughts and really just trying to make someone become, think of all the possibilities. If you look at one chart and you really sit down and think, there's hundreds of different trades you could take that all make sense. And that's what's fascinating about trading. So think about it. If I buy this close and I put a stop somewhere down here and I scale in 2 points lower, the odds of me buying here, scaling in lower, and scalping out even for 2 points above my first entry. So buy this close and I go for 2 points or 1 point. The odds of me winning are probably pretty good. Same thing for the bear that sells here and goes for 1 point or 2 points. It's probably pretty good. So, if I sell this close, 53, it went 2 points. Now, it did not go 3 points. It actually went exactly 3 points. But anyways, a lot of bulls will bet this is exhaustion. Many bulls will wait for the reversal and buy the lower bar and scalp. Same thing here. This is one bar. Think of this as a never-ending time frame. Strong breakout to the upside. Well, this gap's probably going to close, which means we're probably going to test down here. So think of the math of a trader who two things. Sorry about that. So anyways, let's say a bull, they buy this, they say, okay, if someone's, let's start with two possibilities. Remember, I think most people think in one-to-one risk reward. And what I mean by that is typically most people will first consider, okay, what are the odds of me, what's the odds I can, let me try to think how to, okay, if I buy this close, put a stop down here, what are the odds I'll make a one-to-one return or one-to-one risk reward? So if I buy and this is 4 points risk, what are the odds I can make 4 points profit? Well, that's how most people think at first, and then they consider 2 times the risk. So first they think of 1 times the risk in terms of reward, then they think of 2 times the risk. So anyways, if I buy this close stop down here, what are the odds I'll get a measured move up? Well, I don't think it's 60%. So, and I don't think it's 40. I think it's pretty low to bet on 2 times because that's way up here. So it makes more mathematical sense. I'm not trying to sound smart, but it makes more sense to sell this close with a stop up here, betting that price gets down to here. Especially if you sell and scale in. And that's how a lot of traders think. Same thing for here. So a bull that buys here, puts their stop down here, it makes more sense to sell, set a target down here, and put their stop all the way up here. And you can see that's what happened. Bulls took profits. Hope that makes sense. So always in, again, I think I pretty well covered that on this day. So here's the next day, small gap down, still low in the range. Since we're low in the range, still probably always in long. If a bull buys, it's low probability. I think, what do they do? I don't know. I think they get out below here. I say that. It's really not that simple. Maybe buy above, put your stop one tick below, and just bet it's 20% chance. I would not do that. I think the Bulls really needed this to be a breakout bar. And Bears will probably make money, so maybe, I don't know. It's really not a great swing trade because the risk reward is pretty bad. 1 times your risk is up here, 2 times your risk is way up here, so it's really just it's not great math. So here, a strong reversal, maybe always in short, but bad follow through, so it's a warning that we really may not go that further, much lower down. Probably will get at least second leg down, so if I had to do anything, I would sell, stop up here, or maybe stop up here. Strong breakout, testing the lows, so what are we going to get? Are we going to get follow through or reversal? Bad follow through, so probably in the realm of the trading range. Now this is kind of an interesting situation. Sort of a parabolic wedge, 1, 2, maybe 3. what's interesting about this is risk reward. So if I sell, if I buy, sorry, I didn't mean to do that. If I buy above and risk, 10 points or 5 points or 6 points, I'll probably make money if I scale in lower. And this is interesting. So, theoretically, always in short, bears exit above a bull bar, but never triggered. So, we've got sort of a gap. Not really, but maybe a gap from this low to this high. So, that's good for the bears, but still, what's the next bar going to be? Breakout bar. So it looks like the bulls are trapped, and we're getting a give up. So probably at least a little more down. Tight enough channel that any reversal up will be minor. And the bulls really needed this trigger. So kind of leg one, possible leg one, leg two. Maybe leg one, leg two from here, or maybe it's from here, but we clearly reached that. Maybe it started here. I don't know. It's two legs. So this could be exhaustion, and you can see that follow through. So I still think that, if I was an always in trader, maybe I go short here, maybe I go short here, maybe here. But, it's always in short here, probably get out below here. The bulls probably need a micro double bottom, so I wouldn't buy yet necessarily. However, I think it's okay to buy and use a wide stop. And, here starting to go sideways, so I would definitely get out above here. Maybe go long, kind of aggressive, probably need a wide stop. Maybe buy above here at risk 4 points. And, that's kind of what I meant by it's aggressive. So, what do I think is going to happen? Well, I don't know how big these bars are. I haven't really paid attention. So, maybe you need to stop at least something, at a minimum, a measured move down from this high to this low. I think you'll be okay if you use that. Better if you can scale in somewhere down here. And that's what happens. So, you can see this happens a lot. You get a stop entry that triggers, and a lot of bulls put their stop one tick below, it falls below, and reverses up. And to me, that is simply traders knowing that you have weak stops here. And if anything, if a bull buys here, I think if anything, they buy more lower. That's why I was saying you need a at least a wide stop. Bears definitely get out above that bar. I think we'll get back. We'll test back up here. Probably, certainly we'll get up. We're already pretty much there. Certainly, probably we'll get up to these lows. So probably an okay buy. Stop one take below. Again, I'd rather use a wide stop. Bad follow through, so it's a warning that it's a trading range. So we may easily fall below here and turn up again. And there you go. So I just want to, out of curiosity, to see something. And you can see, we reached the measurement down, came close to it. Second entry buy. Probably this was a reasonable buy. So I think, again, bulls buying above here, using a wide stop, buying above here, wide stop, probably, and they probably buy more above here. Probably will make money. You can see that's what happened. That's what happened there. Look right here. What do you notice about this? 1, 2, 3, 4, 5 consecutive bull bars. Character of the market seems to be changing. 3 pushes down, spiking channel. Ultimately, the bears want a large double top, measured move down. Bulls want the opposite. So I still think we're going to test up here. I think we're forming a trading range today. 3 large pushes down, 1, 2, 3. And there you go. I just want to see something real quick. So maybe never really reached that. But anyways, this is one, so let me always in. I personally like wide stops. It's easier. You still got to understand what's going on, though. Always in short. Bulls, bears, maybe they get out above. But, if they do, they got to get short again. But personally, I just wouldn't. I wouldn't sell again. Maybe they sell here. I wouldn't sell this. Too much risk of a strong reversal up. And the whole time I was saying, I think we're going to test back here, and that's because trading range price action, bear breakout, bad follow through, bear breakout, bad follow through. Every strong bear bar gets bad follow through, and that is trading range price action. And as you can see, strong bull breakout, bad follow through. We tested back in the range. Bears will make money probably selling anywhere above these highs. Look what happened. It's a trading range. You have to accept that. When you see a strong breakout, you cannot think, this is a breakout. We're going to go, if I buy, it's off to the races, and I'm going to make a lot of money. That's not how most days work. When you look to the left and you see this, you know you're in a trading range. And it goes back to what I was saying over here. So, bulls, what do? Well, a lot of bears they will sell because they know the bull stops down here, and they're 1-to-1s up here, so they know if they sell, target down here, stop up here, they're going to make money. Especially if they sell for a quick scalp or 2 or 3 points. Double bottom, probably not enough for always in short. If the bear did sell, I can get out of up here. Sideways, probably going sideways the rest of the day, so always in really isn't that effective. There you go. Alright, that's all the time I have for this video. I hope that helps. Really, I want to give kind of a way to think. And this is no different from how Al trades. It's really just, you have to see both sides. Just because you get strong bear bars, there's usually a way for the bulls to make money if they structure a trade. So same thing for the bears over here. There's usually a way for the bears to make money even though we're racing up. So anyways, I hope this video helps and finds value for whoever's watching it. And comment below if you have any questions, or email me, or you can go to brookspriceaction.com, and I think my username is BCWOLFF. You can send me a message. So anyways,